Very good afternoon. In previous class, the various different category of funds we were gone through. For that, I was explaining five different type of funds so far, including many funds, including the index funds. And index funds, I said about the market volatility, how funds are helping the market as well as individual performance. So, the match with the market performance and all this explanation have been given in the previous class. The next fund will be sector or thematic funds. When we talk about sector or thematic fund sector, I said based on the specific seasonal industry. Sector also said that based on the seasonal industry specific fund. So sector thematic fund which has a high risk, at the same time potential of a high return, also can be concentrated. It concentrated on particular segment and risk also can be expected in minimum or maximum. So there are different characteristics of this type of funds. They classify into different classification of industries. Example about thematic fund investment and understanding the objective of this investment plan, or investment in this type of sources where focusing on specific industry like technology, healthcare, and energy related. And obviously, if you see now, healthcare industry is the largest industry where people are investing in form of insurance products, right? Insurance products and expecting the risk rating profile for future, that is classified. But these funds are also helpful for individual to identify that what risks are attached with the inform of investment plan and how much return can be expected after a certain year. So here the character focus on specific industry exposed to specific risk, making them highly volatile and suitable for investor with a high risk tolerance and confidence in a particular sector. So this is how it is classified under thematic funds. So thematic funds are with the high risk, potential high concentrated market. They have a regular character of specific industry and which is identified based on the technology, healthcare, energy, and many other. And these are exposed. This kind of funds are exposed with the high risk, making them highly volatile in the market because they are purely based on the market volatility. Then number seven, you have international emerging market funds. International emerging market fund, it has a higher growth potential than domestic funds. Why? Because we are dealing with the high funds, internationally recognized funds, which has a significant return. At the same time, risk also can be high. So when the fund itself is recognized, and they are the emerging funds in the market where people are recognized those such kind of funds, where many of the people just go for investing in such kind of funds based on the future recognition. I will give example about now. People think about investment in about electric cars, one of the component, one of the investment pattern, or green energy, or solar energy, right? The industry which have been set according to the benchmark of the market. So funds are invested based on international or the local level, but emerging market which help for international local market to look into whether they are the high risk or low risk, high potential for growth, whether they are dependent on the foreign market. All these are based the best setting the best example of a risk return profile. Then there are different characteristics like investing in the international emerging market security. They're exposed to the currency risk, political instability, economic condition. I can tell you, when I talk about international level, uh, investment in form of different pattern in that this fund is exposed under foreign currency or political instability or economic conditions like foreign currency, foreign risk. If the foreign currency value itself is not to that level where exactly investor would like to expect it to get certain return under currency value, or the political instability, government changes its rules regulation which has a highly impact on the industry due to changes in the industry strategy, chances of leading the market to fail, economical crisis due to per capita income of that particular country, the fund raised under international market, or the monetary benefit which has been recognized and which is not fair enough to consider. So chances of international market might lose the economical grip. So chances of fund might lose its market. So it is classified how funds has a different character and how it is exposed in what value. So character higher growth potential than domestic fund, but significantly they are riskier. So higher growth also there, potential market is also there. This talks about international market as a high potential, but domestic market also are significantly risk. Why? Because domestically a low level of people knows about what fund and how much investment or return, but no one ever imagined that international market how it might dip in the market when it's come for investment of emerging market funds. So this is classified under international emerging market funds. Then you have a high yield fund, what we call junk funds. So when we go for junk funds, so normally in junk funds you classify different strategy trends in the junk fund, knowing about the fund. Junk funds invest in the high yield risk bond issued by the company with the lower credit rating. These bonds offer high yield to compensate the increased credit risk. I said about the junk fund, junk bond funds, which is also called investment in high yield, high risk bond issued by the company, and company with a lower credit rating. This is the bond which is issued by lower rating or lower credit rating companies. These bonds offer high yield compensate increased credit risk. See, there are certain company, they run their company with the debt, and they promise that in that company if you invest you get a more return compared to the rest of the companies, but there are chances of you are losing the money. Why? Because entire fund is run based debt base, entire company is running with a debt base. So here some of the character of junk fund will be high yield junk bond, like funds offer higher yield investment grade bond funds to compensate with the high credit risk. Then high risk junk fund, when it's come for investment bond with the lower credit rating, increase the risk default. Or liquid risk, like a junk fund bond may face liquidity risk, making it difficulty to sell bond quickly. This is one of the point. One of the risk of junk fund will be you can buy, but selling will be difficult so easily, so quickly at the fair price. Will be not sold out. Credit risk, like junk bond funds are exposed to credit risk, which is the risk of default by the bond issuer itself. So all these are classified, and you should know about how these liquid risk are analyzed, and it is exposed, and how it is protected when it's come for default by the bond issuer. Then rate of interest is high, especially junk bond funds are also exposed interest rate risk, which risk changes interest rates affecting bond price. 100%, whenever rate of interest goes high, then the cost of particular fund also might go high, and this is how it will classify whether this bond junk fund bonds are reasonably, are very predictable, valuable, whether it is needed, whether it is required to buy and sell now. So all these are considered. And here you can see junk funds are high risk, return is high, invest in the lower rated bonds offering higher yield, then credit risk, issue default, interest rates are sensitive here, suitable for investors seeking high income with the high risk tolerance. Those who have a one kind of a mindset that doesn't matter what risk is involved, but I expect the more return on that. So there are people who want to take risk. Then comes for the real estate funds, what we call REITs. So real estate funds. So basically the real estate funds investment stand with the individual to invest in the real estate without direct owning the physical property. You don't have to get any property, but you are investing in the property. There is no property, but you are investing the property. So this type of real estate funds, they are equity real estate funds, there are mortgage related fund, then hybrid real estate fund, there are real estate mutual funds, there are real estate exchange traded funds. So you should know about when it's come for investing in the real estate funds, when it's come for equity real estate funds, investment in the shares of property owning company or real estate investment trust. You are investing in the real estate owning company, the company which own the real estate property, you invest in that particular fund. Mortgage real estate fund, they invest mortgage and other debt security related to real estate. The company which has a mortgaged or debt security related real estate, you invest in. Hybrid real estate is a combination of equity and mortgage investment plan. Then real estate mutual fund, diversified portfolio real estate related securities. So real estate related security, there you would like to invest. So you should know exactly where you're going to invest when it's come for real estate and what is the history of this real estate which have been funded and given some kind of return. Then real estate exchange traded funds, what we call ETF, were traded on the stock exchange, offering flexibility and diversification. Traded on the stock exchange. When I talk about real estate exchange traded funds, some of the real estate are traded funds. In that case, you should know about that which real estate is traded, which is more flexible, which can be offered more diversification. Based on this classification of stock exchange in the market, that is collectively taken into consideration. So here, the risk is very moderate, return also high. Then character investment in real estate, and it talks about income through dividend, potential capital appreciation, real estate market risk, interest rates changes. So there are certain benefits and risk also under real estate funds. Like benefits are diversification, spread risk by investing in diversified portfolio in the real estate market itself. Then professional management, experienced manager handle the investment pattern. Liquidity, easily buy, easily sell shares, unlike a direct property investment. Then you have another benefits like large scale investment. When it's come to large scale investment, large scale property or projects may be inaccessible through the direct investment. One more benefit is an income generation, potential regular income through rental yield or dividend payment. So this is the benefits of REF, real estate funds. There are risks attached like market volatility. Real estate market can be unpredictable, affecting fund performance. See, today's market and tomorrow's market, and you investing based on tomorrow's market, and everyone invests in the real estate by thinking that in future day it might be go high. Why? Because this is one fund where you will get a fixed rate of return with the heavy profit. So risk also there, but return is highly expected. So market volatility, it talks about affecting fund performance based on the market unpredictable condition. Then liquidity risk, difficulty selling and shares or unit quickly at the fair price. I said one of the risk. Property market risk will be changes in the property market conditions such as oversupply or economic downfall or downturn. If property market collapse, automatically your fund value also will come down. This is risk attached. Then the manager risk, like poor management decision can negatively impact on the fund performance. Then you have a regularity risk, like changes in the law regulation affecting the kind of asset investment. So all these are classified, will be taken into consideration, and regularly this is monitored. Regularly changes in the law and regularly changes in the real estate pattern are affected systematically. So this is how it is classified. Then the next slide talks about target date funds, then ESG SRI funds. So target date funds in form of changes over a time, day wise, date wise, high to low, low to high. Return will be moderate to high initially, then lower as the target dates are nearby. Then these funds, one of the character, they adjust with the asset allocation based on the investor time horizon, when exactly they can invest, when they want to buy, sell it. Start with the higher equity allocation and gradually shift from the bond money market instruments, and they are suitable for retirement planning. Say especially those who are like a core investor investing for the stable income, generating for a future investment plan based on the target date and target number of days. People might go through for this kind of investment plan. So typically, people invest when it's come for high, high to low, low to high, and there are different character of asset allocation based on investment time horizon, exactly when they want to buy, when they want to sell, and what in between profit they want to earn. This is how it works, and how to invest. You need a research to know about the time period which is given, choosing a fund, selecting fund with the investment objective, consulting some of the financial advisor based on the date and year wise, which year it has a high return, which year has a low return, monitoring and adjusting. All these are classified systematically, and based on that classification only, it is considered and whether it is required or not required to invest that which is suitable. So here you have a different classification, and it will enable you to know about different category of funds, and which is going to help you in the long run or long term to sustain your growth. The next you have a ESG or SRI funds. Here you have a ESG funds, so integrated environmental, social, governance. ESG stand for integrate environmental, social, and governance factor which are into investment decision making process. They minimize the negative impact, maximize the positive impact in the society. Okay. Then here the environmental investment based on the climate change, carbon emission, resource depletion, waste management, or pollution, or sustainable energy, renewable resources. All these are very much unique environmental factor where funds have been allocated. Social factor, we talks about labor standard, diversity, equity, human rights, community development, supply chain management and sourcing. When we talks about government factors, here board composition, executive composition, shareholder transparency, all these are what ESG related fund strategies, and there is a high risk and moderate to high return also can be expected. So some of the SRI funds, like SRI funds focus on investing in the company aligning which is called a specific social or environmental value. So this approach often involves excluding companies that do not meet certain criteria. So SRI funds focus on investing in a company that align the specific social environmental value. Okay, SRI funds. So they are sustainable, social responsible investment, which is called one of the character of SRI will be investment in the socially responsible investment pattern. Risk and return depend on the specific industry. They include, exclude, may underperform in short term due to limited diversification. If you see this slide, you'll come to know about the summary of risk return by category wise, where understanding about risk return trade-off, select funds aligned with their financial goal. All these are very much classified, and they enable which factor might include in form of what, like risk return category, equity fund risk is high, return high, bond risk is low, return is moderate, money market fund very low as a risk, low as a return, balance fund risk is moderate, return also moderate, index fund risk is low to moderate, and it matches the market index. Sectoral fund risk is high, return is also high. Interest fund risk is high, return is high. High yield fund risk is high, return is also high. Real estate moderate to high, moderate to high. Target date vary depend with the market. And ESG and SRI said they just go for moderate to high. And here you might be gone through for all the slide of what our funds have been shown to you. Very briefly, I have been explained about different types of funds, the characters of different types of funds, and how it is helping to increase profit or minimizing the risk So this is one of the uh, investment plan option where you can go through for, and you can go through for this YouTube link where different types of investment plans are there. Okay, thank you all. We'll see you in the next class.